The dividend snowball concept is one of the most powerful in investing because it gives both actual monetary benefits as well as powerful psychological benefits. And one of the biggest reasons why individual investors underperform broader market indexes and passive investors over the long term is because they have psychological breakdowns. The market crashes and they decide to sell near the bottom. They fall in love with an individual stock and buy too much of it or hold it for too long, or they simply follow these get-rich-quick schemes and get thrown out of whack. They buy high and then it crashes, they end up selling low or just get left holding the bag. Whereas if you subscribe to the dividend snowball model, it really gives you a great mindset and keeps you grounded through all sorts of market cycles. And what is the dividend snowball model? Well, basically the idea that when you buy dividend stocks, right, they pay you passive income. But if you buy dividend growth stocks and you build a nicely diversified portfolio of them, you get a double growth effect. First of all, the individual stocks themselves increase the payouts year after year. So even if you don't reinvest the dividends, your dividend income stream should be increasing year after year after year. So obviously when you reach retirement and you're not investing in more capital, you're just having your income, you can just collect that, spend it all, and know with a pretty high degree of certainty next year you're going to have even more to spend. And if it grows faster than inflation, your purchasing power actually is going to increase year after year, which is really nice. And if you have extra, you can give it to causes you believe in. You can save extra to give yourself extra cushion for a rainy day in case you hit a COVID or another black swan event that causes dividend cuts. You'll have a little extra to fall back on to boost your portfolio during that time period, or however you want to do with whatever you want to do with the money. But also it means that, if you reinvest those dividends, especially if you're still in the accumulation phase, you're going to get even more dividend income the next year because you're also buying additional shares of dividend stocks on top of, the dividend growth of each share. And so it's like a dividend snowball in that the larger your portfolio gets, the more it pays out each year. But then that also means that the larger it gets, not only will it pay out more, but it's going to grow faster because you're getting more income, which means you can invest more back into the snowball and so on and so forth. So the more time becomes your friend. The power of compounding is working for you when you build a dividend snowball. And this is so psychologically beneficial because you're focused on the dividend income rather than the value of your portfolio at any given time. Because again, if you're planning to live off of dividends, it really doesn't matter what the value of your portfolio is. Sure, it's nice to have a high value portfolio. If some of your individual stocks become richly valued, you could even sell them, recycle the capital into more undervalued stocks to further accelerate the compounding process. That's what I do. Of course, that requires more analysis, more careful active management of your portfolio. You have to keep tax implications in mind. So it sophisticates things a little bit, but if you can do it right, handle taxes right, if you do it in a Roth or a standard IRA where taxes are not as much of an issue, that's a great way to do it. That's what I do. But regardless, you can be focused on the income that you're bringing in. So if the market crashes, who cares? My income's still coming in. If the market soars, who cares? My income's still coming in. If anything, you actually want the market to fall because that makes it cheaper to buy new shares with your reinvested dividends and any other active income that you have coming in towards savings. And so that helps you grow even faster. So again, that's why I love the dividend snowball. So in that spirit, in this video, I'm going to talk about 8 individual stocks that I think are great candidates for a passive income snowball. Before I get into that though, if you could please give this video a like, it'd really greatly aim in its distribution. Thank you very much. Okay, so one of my favorite areas to invest when I want high yields, but also sustainable distribution growth and those yields to be sustainable over the long term is midstream infrastructure. That's because they have really strong balance sheets right now. They've really cleaned up their act to not be dependent on capital markets. They have the ESG movement to thank for that. They realize, okay, a lot of investors are steering away from hydrocarbon related businesses because they want to invest only in clean technology. And so we can't be dependent on investors anymore. We need to just be reinvesting our own capital to be able to fund our growth projects. And so that's what Midstream's done. It led for some painful years of underperformance, but they've completed the transition now and they're on much more solid footing. And so they pay out a lot of distributions as well because they're generating copious amounts of free cash flow. They have very strong balance sheets, very defensive and stable cash flowing business models with long duration contracts on their pipelines or even regulated assets. And so I really like that there. Of course, a lot of these midstreams issue K1s, so people who don't like K1s, you can buy some C corporation stocks like Enbridge is a good one, or TC Energy, Kinder Morgan, the Williams companies. Those are all solid picks. There are others as well. Or you can just buy an ETF that holds a lot of these MLPs that issue K1s, where you can get even higher yield because of the K1s lead to higher valuations, since many investors and institutional investors tend to steer clear of them. But you can buy MLPA, which is the Global X MLP ETF, or the Illyrian MLP ETF, which is AMLP. Both of those issue 1099 tax forms. Of course, you pay them an expense ratio, which does reduce your returns over time, but you still get a high yield. You get that nice diversification. You don't have to worry about the K1 hassle. So your pick. But if you want individual MLPs that issue the K1s, which is what I like because you get tax deferral benefits if held in a taxable account, don't hold the K1s in a retirement account. By the way, it's not tax advice. It's just my opinion based on experience, but do your own research. But, if you want those, there are many that I like. Obviously, I've mentioned Enterprise Products Partners in many of my past videos is one I really like. But there are others I like too, like Energy Transfer, MPLX. Both of those have around 8% forward distribution yields, expectations of growing their distributions at inflation-beating rates for the foreseeable future. BBB credit ratings, which are quite solid and attractive. Strong free cash flow with well-laddered debt maturities. So a lot to like there for both those companies. Good, solid, well-diversified business models. Then there's Plains All American Pipeline, which has a PAGP ticker symbol equivalent, which issues a 1099. Again, for those who don't like the K1, but PAA does yield a little bit higher because it's, again, a K1, less people want to buy it. But it's growing its distribution at a very fast rate right now, a double-digit annualized rate for probably at least the next few years, which combines with about a 7% or a little bit higher distribution yield to make it one of the most compelling distribution growth stocks out there that also has a BBB credit rating, a good, solid business model, especially its assets in the Permian Basin are quite attractive. And so that's one I really like as well. And so those are at least three really good passive income snowball investments you can make. Turning to the real estate investment trust space, that's another great option for investors because, again, they don't have to pay income tax at the corporate level. They get long duration cash flows from their leases, especially certain business models like triple net lease. They pay out very high dividends. They appreciate, the real estate appreciates over time, and their cash flows grow through fixed rent escalators as well as some retained cash flows that they reinvest in new properties and redevelopment projects. And so it's a great source of high current income with sustainable long-term dividend growth. And two ideas that I like right now, among many, are EPR properties. They are an entertainment-focused triple net lease REIT. They own theaters, Topgolf facilities, and many other entertainment-type assets. In fact, they're diversifying away from theaters into these other entertainment-type assets, making them pretty well diversified. They've proven to be remarkably resilient during recessions, again, because of the triple net lease structure. And many people during recessions still, they want to get out and have experiences, especially the younger generation is more experience focused rather than goods focused. And so EPR is tapping into that trend. And even their theaters, which are viewed as their riskier assets, the ones they own are among the most profitable in the United States. And there have been some strong movie performances in recent years. And so I don't think theaters are going away anytime soon. Again, these are not investments in theaters in terms of the profits of the theater themselves per se. They own the real estate and they lease it out to theater companies like AMC and others who then pay them rent. And again, these are some of the best assets in the United States. So even if a certain tenant goes bankrupt, they can bring on another one who would love the facility to be able to use it because it's a very profitable asset for them. And so, they have an over 7% dividend yield. They've been growing the dividend. They have a strong investment grade balance sheet that they've also been strengthening. They're strengthening their portfolio through diversification efforts. And so when you combine that high yield with dividend growth with their very cheap valuation, both on a price to NAV basis as well as a price to AFFO or adjusted funds from operation basis, they're undervalued. And I think that they could deliver pretty attractive total returns over the long term. Again, it's not the lowest risk REIT out there, but I think there's some potential there. Another one that I like for people who are more risk averse is NNN REIT, or formerly known as National Retail Properties. That's a well-diversified, primarily retail-oriented REIT. It has a lot of single-tenant freestanding properties like restaurants, etc. Recession-resistant, low risk, especially with the broad diversification, pay around a 5% dividend yield. They've been growing every year, that dividend for decades. Probably will continue to do so at about a 5% rate moving forward, maybe 4%, depending on their cost of capital each year. It just vaults on that regard. But overall, you're going to get market level or even market beating total returns from NNN. Quite low risk. You're going to get a nice bond-like 5% yield with inflation meeting or beating growth. It's a great way to build a dividend snowball. Again, you're not going to crush the market with NNN, I don't think, from here, unless interest rates just plunge. But you're probably not going to underperform it over the long term either. And it's a great way, again, to get nice, consistent, steadily growing passive income. Okay, and then I'm also going to talk about the BDC space here. Two picks here. Again, these are not ones I would pick if I wanted to crush the market or even beat it. I think these are ones that are just going to pay you nice, dependable income and grow it over the long term. Maybe you'll sleep well at night for your passive income portfolio snowball. So the first one is Main Street Capital. It's one of the best performing BDCs over the long term. It's one of the few internally managed ones, which gives it a very low management cost compared to a lot of peers, which are externally managed and charge fees that scale with the company versus internally managed, which means they go down on a percentage basis as the company scales. It has a nice dividend yield of around 6%. It invests primarily in floating rate investments, so it's a nice diversifier. If Fed has to go through a rate hiking cycle, MAIN will likely outperform the rest of your portfolio, especially these bond-like dividend stocks that I was mentioning. but its lower yield means it retains more of its cash flow and also invests in a lot of equity. And so those investments enable it to grow its dividend at a much faster pace and more consistently than the vast majority of its BDC peers. So it's a rare BDC that's a consistent dividend grower while still offering an attractive yield, has an investment grade balance sheet, phenomenal track record over the long term of creating value for shareholders. Solid pick. The other one I really like is Blackstone Secured Lending, ticker symbol BXSL. It's managed by Blackstone, the largest alternative asset manager in the world with over $1 trillion in assets under management. And that gives them a lot of advantages through the network that they have, the proprietary data that they have, the cross-selling that they do within the Blackstone universe. It's almost like its own country that you can buy and sell from companies within there to support them. They have a large workout team, can help if any of their loans do get into problems. But the thing to like about BXSL is that basically the entire portfolio is first lien senior secured loans, which is the lowest risk structure of such a sponsored backed loan. And so they have a much lower risk profile. They should be able to withstand recessions really well. Again, they have that floating rate exposure that helps during rate hiking cycles while still having substantial coverage of their dividends. So if the rates get cut, they still should be able to support their base dividend. They have one of the lowest fees among externally managed BDCs in this sector, which is surprising given how great Blackstone is. And they've performed very well so far for investors, both from a dividend growth perspective. They've bought back stock when it traded at a discount to NAV, and now they've earned a nice premium to NAV, so they can issue new equity accretively to grow the book value per share, the NAV per share, the dividend per share over time. And they're on a good course here. Again, they're not cheap right now. They trade at a pretty rich valuation, but I think over the long term, they'll do just fine. And their yield is over 10%. And so they have a lot going for them right now. That makes them a good pick for someone who just wants to sleep well at night, high yield stock. Okay, finally, I'm going to talk about industrial stock, LyondellBasell Industries. It's not that well known by a lot of people. It primarily is involved in, you could say, the chemical space. They make some polymers, plastics, etc. And they're a dividend growth machine. They have like a 5.6, 5.7% dividend yield right now. That's well covered by earnings. They have a pretty low payout ratio. They have a very strong balance sheet that earns them a very strong investment grade credit rating, very low leverage risk, refinance risk, etc. They've been growing the dividend at a very good clip. They just grew it by 7% this past year. I would expect that to probably be about 5% moving forward. They've been buying back stock quite a bit as well, quite opportunistically, creating a lot of value for shareholders that way. Nice diversified company across many geographies, but mostly focused in the United States and Europe, which again insulates them from some geopolitical risk with limited exposure, especially capital exposure to China. So I like that about them as well. So if you're looking for an industrials pick that pays a high yield but also has a strong dividend growth rate, I think LYB is a great pick. In fact, they're expecting to grow their earnings per share at a double-digit CAGR moving forward. And so that, when you combine that with the yield and their pretty cheap valuation, I don't see why you'll get any less than a mid-teens annualized total return over the next 5 years, especially if the economy remains on pretty sound footing. So there you have it. Hopefully this video added a lot of value to you, gave you some good ideas for how to build a good dividend snowball for yourself, or at least to start towards it. Of course, these can all be grouped with an ETF like SEHD, which I've discussed in other videos, to really create a well-diversified dividend growth snowball. But if you like the video, please subscribe to my channel to get more ideas like this. I'd greatly appreciate it. Thank you so much.